There's an institution that affects your mortgage, your job, and the price of your groceries, and you never got to vote for it. It's called the Federal Reserve. And once you understand it, you'll understand why everything in the economy moves the way it does. The Fed is the central bank of the United States. It's not a normal bank. You can't open an account there. Only other banks can. Think of it as the bank for banks. It holds their reserves, lends them money in emergencies, and sets the rules of the game for the whole banking system. But why does it exist? The answer takes us back to the early 1900s, when the US had no central bank and financial panics happened every few years. In 1907, a banking panic nearly collapsed the entire US economy. Only one man, J.P. Morgan, a private banker, stepped in and personally saved it. Congress realized, we can't depend on one wealthy man to save the country every time. So in 1913, they created the Federal Reserve. Today, the Federal Reserve has two official jobs. This is called the dual mandate. Job 1, keep inflation low and stable, around 2% per year. Job 2, keep employment as high as possible, meaning as many people working as the economy can sustainably support. The problem, these two goals can pull in opposite directions. Fighting inflation sometimes means slowing the economy, which costs jobs. Balancing these two goals is the core challenge of the Federal Reserve's job, and it's why its decisions are so watched and so debated. To do both jobs, the Federal Reserve has one main tool, the interest rate. Specifically, the federal funds rate, the rate banks charge each other to borrow money overnight. This one number flows through everything. When the Fed changes it, it triggers a chain reaction across every corner of the economy. When the Federal Reserve raises rates, borrowing money gets more expensive. People buy fewer houses, businesses take fewer loans, and spending slows down. Slower spending means less pressure on prices. That's how raising rates fights inflation, not directly, but by cooling demand. When the Federal Reserve cuts rates, the opposite happens. Borrowing gets cheaper, people spend more, businesses hire more, and the economy speeds up. But cutting rates too much can overheat the economy and bring inflation back. The Federal Reserve is always trying to find the temperature that's just right. Who actually makes this decision? A group called the FOMC, 12 people, the 7 Fed governors plus 5 regional Federal Reserve Bank presidents. They meet roughly every 6 weeks and vote. One vote and mortgage rates, savings rates, and credit card rates begin to shift across the whole country. Now here's where it gets global. Because the dollar is the world's reserve currency, Federal Reserve decisions ripple into every major economy on Earth. When the Federal Reserve raises rates, money flows into U.S. assets. The dollar strengthens. Other countries' currencies weaken. Their imports get more expensive. Countries that borrowed money in U.S. dollars suddenly find their debt more expensive to repay. A single Fed decision can cause crises in emerging markets. This is why finance ministers and central bankers across the world watch every Fed meeting so closely. Their economies depend on what 12 Americans decide. The Federal Reserve also acts as a lender of last resort. When a bank is in crisis, it can borrow emergency funds directly from the Fed, preventing collapse from spreading. And through something called quantitative easing, the Federal Reserve can buy government bonds to inject money directly into the financial system when rates alone aren't enough. Here's where it gets controversial. The Federal Reserve is independent from the government, meaning politicians can't legally tell it what to do. Supporters say independence is crucial. Politicians might cut rates before elections to boost the economy, even if it causes inflation later. Critics say, who elected these 12 people? Their decisions affect hundreds of millions of lives, yet they answer to no one directly. Both sides have a point. The Federal Reserve is an imperfect solution to an impossible problem, managing the most complex system humans have ever built.
Now, when you hear the Federal Reserve raised rates, you'll know exactly what it means and why the whole world pays attention. Subscribe for more.